Hi, I'm Jeff Tucker, the principal economist at Windermere Real Estate, and these are the numbers to know right now. The first number this week, 2.4%. That's the annual rate of inflation in the Consumer Price Index in September. It was a step down from 2.5% in August, but it didn't drop as much as the consensus forecast, which was expecting 2.3%. Another data point here in the red line is the implied annual rate of inflation based on the monthly changes, which was 2.2% in September. You can see that that's been more volatile, including some overheating back in Q1, but in general, it's been cool enough to bring annual inflation down for the last several months. Inflation has had a long, rocky road downward since it peaked at 9.1% in summer 2022. And this is another step in the right direction, but it's still a little concerning that it hasn't been dropping faster. So, combined with the strong September jobs report I discussed last week, all of this means that the Fed might be having second thoughts about how quickly they need to cut the federal funds rate going forward, especially after they started it off with a bang by cutting half a point in September. Now, there's even some discussion of the Fed pausing on rate cuts at their next meeting in November. So, that's a possibility I think we should all be prepared for. In the meantime, the combination of renewed labor market strength and a slower cooldown in inflation has been enough to push up long-term yields like mortgage rates, which brings me to the other number to know right now. 6.64% is the latest 30-year mortgage rate according to Mortgage News Daily as of Friday, October 11th. It's up about half a point from where it stood 1 month ago, which goes to show the impact of these data points of a stronger jobs market than we thought, as well as maybe not such a fast drop off in inflation. To put that in context, it's still down a full point from where it stood last year, but clearly that sort of steady progress downward in mortgage rates has been interrupted for now. Looking ahead, for mortgage rates to resume falling, we probably need either some reassuring data showing inflation cooling down, or we would need to see some more signs of labor market deterioration, or both. Interest rates went up so much because the economy was running hot, arguably overheating for a couple of years. So now markets need to see more convincing evidence of a cool down to get us out of that high rate environment. All right, that is all for this week. Thanks for watching, and don't forget to subscribe.